Thank you very much. Yeah, sorry to disturb you again, but we want to move on a little bit with the program because it's not getting too late. We are already a little bit behind our time schedule. But I'm really happy today because it might be a little bit of an historic day. Not that you know, when I'm wearing my green pants, the markets are green, the markets are on. Yeah, I wore that already, I think, last year in November. And I told you we have the feeling that really commodities are coming back and really the thing is working. And it's all about the pants, you know. But what is really important, it looks like the perfect timing today, because maybe you saw on your little iPhone apps that silver went up 50 cents, gold was already close to 1360, but what is even more important, platinum, palladium has started to move the last 2 days, and also copper all of a sudden was up by 8 cents this evening. What does this tell us? It's getting interesting, ladies and gentlemen, because I have the feeling 2018 is the starting year when really the financial crisis from 2008-9 kicks in. Why? Because we saw way too less exploration. We saw big companies shrinking the budgets. We saw big companies, looking to go into survival mode. But what do you do when you're not exploring? You have no ounces for the future, or no reserves or resources. So this is kicking in now, and believe it or not, the electric mobility is going to change our commodity world completely. And this starts this year. We already saw in China 2016 and 2017 rising e-mobiles on the streets with growth rates of approximately 50% per annum. And we have now worldwide approximately 3.5 to 4 million e-mobiles and e-cars running. This is nothing compared to what is coming within the next 2, 3, 4 years. And what has this to do with gold and silver? Quite simple. First of all, gold, that's the insurance. That's what we all need. But silver, believe it or not, it's a big component in the e-mobility because you have to use the electric side inside. You have to transmit. You need all those chips. You need to wire that stuff. But on the other hand, solar panels is the big thing for silver. Maybe you don't know that. 1 gigawatt of solar panels consumes 3 million ounces of silver. The Arabs last week said, we're going to build 200 gigawatts. The Chinese, in November, when they had their 5-year congress, they said, we're going to build between 50 and 100 gigawatts in the next 5 years. Do the mathematics. This is more than 1 year world production for silver. And this is one part where the demand comes on. The other driver is Amazon. Why? RFID chips. Amazon is delivering the world. And each parcel is a little RFID chip. And RFID chips are made out of steamed silver. So it's going to be exciting for all those metals, especially the companies we are having here today and this evening, and also the companies I interviewed today and yesterday. And we want to start now with our mining panel. And already I advised the hotel to bring down the air conditioner a bit. Jesus, it's really hot. And I saw a lot of other guys here sweating around. So thank God it's not only me. I thought it's because of my form, but honestly, also skinny people sweat. So let us start now with the mining panel. And I'm pretty sure you are all looking forward. I want to introduce to you Agnico Eagle. Sean Boyd, please come up here, who is the CEO of the company for more than 20 years now. Yeah. And yes, please, that would be great. Sit down, thank you. Agnico Eagle is a senior Canadian gold mining company, and I'm pretty sure all of you know the company, producing since 1957 and celebrated last year the 60th anniversary of their company. Their 8 mines are located in Canada, Finland, and Mexico, with exploration and development activities in each of these countries, as well as in the United States and Sweden. The company is a great success story and pays cash dividends, very interesting and important in times with no interest. Cash dividends every year since 1983 and rewarding shareholders. Agnico Eagle has a growing high quality, low risk, sustainable business model established and will do so in the future through maintaining a high quality project pipeline and production. Sean Boyd serves as Vice Chair and Chief Executive Officer of Agnico Eagle Mines and he was appointed as the company's CEO in 1998. So you celebrate the 20th anniversary too here. Wow, congratulations on that. Hello.
Thank you. Thank you.
And I want to say he's the team leader behind the success of the company for the last 20 years. Please welcome him. So, next company, Osisko Gold Royalties. Where's Sean Rosen? Please come up. Please have a seat next to Sean. Thank you. Osisko Gold Royalties is the #4 worldwide as a precious metal royalty company currently and is focused on the Americas. The company started their business in June 2014 and through the Orion transaction, Osisko now holds a North American-focused portfolio of over 130 royalties, streams, and precious metals offtakes. Osisko's portfolio is anchored by 5 cornerstone assets, including a 5% net smelter royalty on the Canadian Malartic mine, which is the largest gold mine in Canada. Osisko also owns a portfolio of publicly held resource companies, including large interests in Osisko Mining, Barkerville Gold Mines, and Falco Resources. They also pay, again important, a cash dividend quarterly to reward their shareholders. Sean Rosen is the chair of the board of directors and CEO of the corporation. Sean was a founding member of Osisko Mining Corporation in 2003 and of Eurasia Holding, a European venture capital fund. He has a track record over 30 years of outstanding experience in the mining industry and, of course, success. Please welcome him. Thank you. So, last but not least, OceanaGold. Where is Mick Wilkes? Yeah, please. Mick Wilkes. He's the CEO of OceanaGold. Please come up, Mick. OceanaGold is a, sorry, wait for that. Please sit next to Sean here. Thank you. OceanaGold is a mid-tier, low-cost, multinational gold producer with assets in the Philippines, New Zealand, and the United States. The company's flagship operation is the DDPO gold copper mine on the island of Luzon in the Philippines. On the North Island of New Zealand, the company operates the high-grade Waihi gold mine, and on the South Island of New Zealand, they operate the largest gold mine in the country at the Macraes Goldfield, which is made up of a series of open-pit mines and the Fraser's underground mine. In the USA, completed Oceana the construction of the Haley gold mine in South Carolina in 2016 and achieved commercial production in 2017. OceanaGold has a significant pipeline of organic growth and exploration opportunities and pays a semi-annual dividend. You see, again, success companies pay dividends, and rewards their shareholders. Mick Wilkes is the president and CEO of the company since January 2011, and he is a mining engineer with 35 years of broad international experience, predominantly in precious and base metals across Asia and Australia. So, now let's get started. Oh, sorry guys, it's crazy. That shows how rich Switzerland is, huh? Thank you.
I'd like to congratulate Jochen on getting through that. That was a lot of words.
So, fantastic. All right, let's get started with the mining panel. And we have also time afterwards to do a little bit of a Q&A. Patrick has a microphone, so then you can raise your hand when I tell you to do so. Sean Boyd, Sean 1, Sean 2, I will do it like that.
I'm good with that. I'm good with that.
They call me Sean as well?
Sorry?
You call me Sean as well?
No. That's Mick 1.
Did you wear the green pants because we're Irish? Is that especially for us?
Well, honestly, I didn't think about it, but if you say it, why not? Sure.
So, Sean, I'd like to serve this up with you and I, being two Seans in the Irish theme. Anybody in the room that buys a pair of green pants like Jochen's, if you send Sean and I a picture, we'll pay for them.
Perfect. And what he forgot to say is that they send an ounce of gold for the trousers.
Yeah, we skipped that part, but you know, we'll talk. Depends on the quality of the photo.
Okay, fantastic. Well, Sean, let's start a little bit. First of all, I would like to do a little bit more on the, let's say, general side, and then we dive into your fantastic companies. Since a few years, there is a peak gold scenario, which has been brought up by a lot of analysts, of course, also. Do you see such a scenario as probable in the near or to midterm?
Well, it's hard to get a lot of visibility because a lot of companies may give sort of 2-year guidance. But I think it's clear we're seeing declining reserves and resources. We've seen over the years declining grades. We know that the location of these deposits, they're much further away from infrastructure than they used to be. So it's become much more challenging and much more complex. I know Goldman Sachs said recently that in 20 years there's no gold mining industry based on the reserve position. And I think the point you made at the start, where there's a period of under financing of exploration and development activities has put the industry in a position where it's challenging to grow, and there's not a lot of growth there. So it's hard to call it peak gold. I know that's a good term, but I think the point is even if gold goes up $200, $300, $400, $500, there isn't a lot of production coming on stream because these things take a long time from drill hole to production. So the supply side is something you don't have to worry about.
Absolutely. I think it's quite the same like we saw in the oil industry probably, yeah? And also I think maybe one point is that all the gold which was produced is still here. I mean, it's not really consumed, right? So could you imagine that a lot of gold already finds the way back to the market?
You see scrap, but that's accounted for. I think the key thing is the demand side. The Chinese aren't going away. Why did they establish the Shanghai Gold Exchange 15 years ago? Create a market. And that's more strategic than anything else. India is not going away. Central banks are still buying. We're waiting for the investor. The investor's buying gold, but not in quantities that's significantly driven the price. But they showed up at the first half of 2016, and they'll be back. And you can see the dramatic impact that we had on the gold shares during that time.
Sean, a question for you now. Do you see the discovery of new ounces getting more difficult, respectively pricier, or is that currently not the case? And also with all the political risks and some negative developments in certain mining jurisdictions, one would expect maybe growth constraints for the industry?
Well, you know, Jochen, as you know, we've been one of the most successful exploration development groups in recent history, with over 80 million ounces of discoveries worldwide within our technical team. So we have a pretty good viewpoint on what the potential discoveries could be and how much they can provide. You know, I was very happy to be here tonight with Sean. We found and built Canadian Malartic. We bought it for $88,880. We invested $1 billion and we sold it for $4.1 billion. So obviously the value of exploration discovery is there, but the technical difficulty in executing exploration successfully is much more expensive and much more difficult and much more technical. So I think that, you know, when we look around the sector, there is not a lot of opportunity for easy ounces. You know, we're not in the 1980s where there's 10 oxide deposits showing up. So it's become a much more scientific, much more expensive endeavor to discover ounces. And I think that as we look forward as our group, we see that is, you know, really in our wheelhouse, and that's where we can deliver value. We've grown, you know, 4 or 5 companies over the last 36 months that were essentially unknown resources, put them into the resource category. We'll have a couple more coming out. But it is not easy work, and it is not, you know, it's not without capital intensity. We had 41 rigs turning last year across Canada. We were probably 60% of the exploration business in Canada last year, and maybe 30% of the exploration business worldwide. So it's, you know, it's a capital intensive business and it requires more and more science. So we see the things as, yes, there is value to be unlocked, there is things to be done, but we're getting more and more into a more difficult cycle of exploration development. We're requiring much more technology, and we're going to require a lot more longevity in terms of the time in which we invest in exploration development. if we're going to meet the demands, as we saw in terms of providing ounces and trying to provide resources that the mining community is going to be able to convert to the demand that it really, we believe, is pretty significant in terms of everybody in the world is looking for an insurance policy, as you said. So we think that there's a lot to do, but it's going to be expensive and it's going to be probably very high tech.
Absolutely, yeah. Mick, question for you, of course. Many investors have been wondering about the current disconnect of physical gold and gold mining equities. Has anything changed on the margins per ounce or other factors that would justify the current absence of investors in the sector?
Well, firstly, thanks to Patrick and Andre for setting up this event again. I was here last year and I thought it's a terrific opportunity for investors to get close to mining companies and find out what's going on from our side of the fence. In relation to what's happened to the market, no, there's nothing fundamentally changing from a corporate perspective. The operators, I think the gold mining industry has never been in better shape because costs have been cut. Most gold mining companies are making cash now. We've taken our medicine over the past 3, 4, 5 years, and the industry's in pretty good shape. But we're not getting recognised by the markets for that, that rejuvenation, if you might call it. But costs are under control. Oil's gone up a bit, but it hasn't been that significant. Labour costs, there's really not any pressure. New technology is allowing us to do things smarter and cheaper, and that's a point I want to sort of labour on a bit because I see huge opportunity in technology to increase productivity and reduce our cost base, which is going to lead to higher reserves, higher profit margins and the like. And I assure you that the days of no one working underground is not that far away because of through automation and electrification of equipment, etc. So I think the industry's in a good shape. I mean, we really are in a good place, and the market's gone the other way. We're unloved, and I had a conversation with you yesterday, Jochen, about this, and every other sector is booming. And the commodities, at least the gold space, is not. It's not getting the attention. There's so much focus on the tech industries and how can Tesla be twice the size of Ford? And the young people are starting to understand that there can't be value there. So we're in a bit of a bubble in that space. But the gold sector, the commodity sector, is not getting the love. And therefore it's a great place to invest. And I think that disconnect, which we saw very clearly in the middle of last year, where gold continued to its progression upwards, and the equities, including ourselves and some of my peer companies, went the other way. That's going to come back. And I'm not suggesting it'll come back with a huge rush, but this correction in the gold sector is going to happen in the near future.
Yeah, it's all about maintaining margins and make sure that also at $1,200 you make still enough money that everything is going well, right? You said something with labor and also, let's say, also with taxes. Maybe a question to all three of you, and I don't know who wants to answer, or you all can answer, of course. But I saw, for example, in Chile, Escondida, they have in June a lot of negotiations for new wage tariffs. Yeah? Do you see any problems arising, maybe at your mines, or even in the future? On the one hand, that, let's say, the trade unions are playing a more harder role on you, and on the other hand, do you see also that we saw it in several countries, all of a sudden they raised royalties, they raised the taxes for income on the mines, for example. Do you see there something which might come up, or do you think we're all in good standing so far?
I can go. We are predominantly, our production's Canadian. 2/3 of our production's coming out of Canada. We're non-union, never been unionized in Canada. We negotiate our wages annually, and we do it in an afternoon with an employee committee. Our increase this year was 3.5%. So we're not seeing, wage price pressure that existed 10 years ago. But we think that costs have probably bottomed and are heading up. As far as taxes, we haven't seen a lot of tweaking up of taxes. We are in Finland. The Finnish tax rate is 20%. Nice. The Mexican tax rate went up a few percentage points, but they have a brilliant policy. The taxes that we pay come right back into the communities, so the people see the benefits. I think we make a mistake in Canada. In Quebec, our effective rate is almost 50% when you add in mining tax. And unfortunately, it doesn't find its way back. And I think that's what governments have to do because we need to continue to have the license, social license to operate. If you can see tangible benefits to the community, then you've got people on your side. And what we see in Nunavut in particular is you can see the residents of Nunavut own 18% of the land mass based on geological potential. Yeah. That's how they selected it. They want resource development. So they're pro-mining. And that's reflected in government policy in Nunavut to promote that. So we're not really seeing a lot of headwinds.
Great. Mick, you want to add something on that? Because you're on the Philippines, you're on New Zealand, that's maybe a little bit different.
Yeah. Well, we have unions in New Zealand, and relatively they're fairly passive. There's no unions in South Carolina. I think it's outlawed. And in the Philippines, we have a union, but again, there's not a large proportion of the workforce that have joined. But notwithstanding that, I mean, my view is that you get the unions you deserve. Good companies don't have problems with unions because they don't have problems with their employees. And if you're a good employee, if you're a company that people want to work for, that people are proud of working for, that people want to come to work every day, they're not going to challenge you and get to collaborate, get together because the boss is a bad guy, right? They want to be there and be part of the future. So you get the unions you deserve. Now, big companies like BHP, they're so big. They face union challenges in Chile. That's a different scenario. But most of us in the gold sector are not like that. We're not those big companies. We have employees that are connected to our future, or we like to think we have. So I don't think wage pressure is a big deal for us at the moment. I don't think so because mining is not overheated. Certainly in Australasia, the mining is going very well. The gold sector in Australia is an anomaly because the gold miners are making so much cash and they're flying. Right, and there's so much exploration going on, and that's leading to more underground mining and whatnot. But we're not seeing wage pressure.
Great. You want to add something because you're in the great position that the ounces fly to you by itself?
I would like to add something on the Canadian government. We enjoy a very special situation in Canada, which is called flow-through share investment, where we're allowed to fund, both on an individual and a corporate basis, junior mining companies to execute exploration. And when we do that, we can deduct somewhere between 100% and 125% from our taxable income. So as a royalty and service company, we've been able to start our company. After my transaction with Sean in 2014, we had a $50 million tax pool. We've made $300 million in revenue since then. We've never paid taxes. And most of that has happened through the fact that the Canadian government and both the provincial governments are progressive about encouraging the mining industry, that we're able to reinvest into exploration companies and continue creating wealth for Canadians, and in particular First Nations communities, because a lot of the exploration that we do is in First Nations communities, and we're really the only ones that are investing in those communities. So Canada has led the way, I think, in terms of tax structure, in terms of encouraging exploration development, and really setting the table for wealth creation, which is why we're dominantly a Canadian company. And I have a $400 million equity book, and I can tell you that $150 million of our equities were purchased through the flow share program. So I think governments need to actually look at the Canadian model and maybe deploy it a little bit in other environments, because this is a really good way of taking potential taxes, converting them into wealth creation businesses, especially in areas that may not see that level of intensity of investment if that tax scheme wasn't there. So it's been really good for us, and we're onshore. We currently have $500 million worth of tax pools. We don't envision paying taxes till 2021 on our onshore assets, and that is essentially due to the Canadian model. So the Canadian government has done a great job, I think, at setting the table to continue to encourage the exploration sector, especially in the north where Sean and I operate. There's a lot of government support to make that happen, and you as shareholders in the room today need to understand that that's an important aspect of his business, my business, on the Canadian side, is that is the great Canadian advantage. As we speak today, we have Ambassador from Canada with us tonight, and I would like to congratulate the federal and provincial governments on really doing an outstanding job of defending that tax policy.
We built the LaRonde and the Goldex mine in the 80s, LaRonde, and then followed Goldex, predominantly raising money through the flow-through mechanism. So it's been around for a few decades, and it's resulted in a number of big deposits being built in Canada.
That's a very powerful instrument, definitely. Yeah. Let's come a little bit to M&A. I mean, you guys have been all very active, Sean. You were the most active, I would say, last year. I think you did 1.6 billion transactions altogether. But this is a question also for all you three, please. More recent M&A transactions showed quite a wide range of price differences, of course, per acquired ounce. I want to have some thoughts on it, and also I would love to have some thoughts on maybe a further consolidation in the industry, because you are the companies which are really successful, have a lot of cash, a lot of experience, and it's so damn cheap out there.
We're going to take over one of Sean's companies because we want the drills. We can't get drills. He's got all the drills.
Maybe you should talk to
Stop hogging the drills.
Well, I fess up for the drills, but I also hog the labs. So, guilty as charged, Judge. Yes, all the drills and all the labs are working for us. We have an internal Osisko policy called SUDS, which stands for Shut Up and Drill, Stupid. And that has caused some anxiety for other people who are trying to carry out exploration within the space. I apologize for the inconvenience, but we're gonna keep on with our program.
Yeah.
Well, M&A. I think there's been an expectation over the last few years, when is it going to happen? I think the backdrop is there's far too many companies for the number of high-quality opportunities that exist to be able to grow the businesses in a way that create value. So there should be consolidation. But I think companies are a bit apprehensive because literally anything that gets announced today, the instant reaction is always negative, even if it's good. It's always negative. So you have to sort of work your way through there. I think, we understand there's a fair amount of activity and discussion within the space on trying to get things done. Things are not easy to do. We would anticipate seeing some. As far as Agnico is concerned, we're sort of at the margins, looking at small things and looking at things that we can bring along over several years and turn into meaningful parts of our business. But we would expect deals to happen. There are certain companies that the only way they can replenish reserves is to buy them. So they're going to be forced to do that.
Absolutely.
Look, I think that M&A is part of our business. It has been, and it always will be part of the business. An amalgamation of companies, transactions, buying juniors, etc. And where the value is at the moment is obviously with the explorers. They are not getting the funds generally from the market, so where are they going to get their funds from? There's a lot of corporates that are stepping into that space because it's very good value at the moment, and we at Oceana have done that in Argentina, we've done that in Nevada, and we continue to look for opportunities for value like that. There's always opportunities that come and go in the market, and you don't want to just do a deal for the sake of doing a deal. You don't want to just get bigger for the sake of getting bigger. There's hardly any motivation or rationale for doing that. But sometimes there is a real strong rationale for doing it, and those transactions should happen, and they will happen. But my experience, and I don't have as much experience as these two gentlemen from Ireland, but you know, my experience in this financial world is that you've got to be really disciplined and you've got to be very patient, and the right deal will come along.
Absolutely. Yeah, and you have to search for it. Yes, Sean?
So I think the largest M&A deal that was done in the gold space was, Sean and I did it in 2014 in recent history. Worked out great for both companies. We created the Osisko Gold Royalties off the back of it. It's a natural evolution. It's a natural monetization for shareholders. And it sets the stage for management teams to go on like we did and create more value. So I think that the setting in which you can get an M&A deal that's accretive is a very specific moment in time. And it's, in an uptick market, everybody feels like, I have so much more blue sky. In a downtick market, everybody feels like, I'm down so much more than the other guy. So it's a very specific moment in time when M&A can occur, and it's much more difficult than people think it is. It's not just a couple of bankers showing up at his door and my door going, hey, you guys should do this thing. It's much more complicated than that. But what I would say is that, in terms of the way the market is moving now, and we're seeing consolidation, and we're seeing a change from active shareholders to passive shareholders, ETFs, and the rest of it, that it's become much more complicated to execute an M&A deal, because if you want to get your shareholders on side, and collectively between two companies, 20% of the shareholders are in passive management and ETFs, it's not really a known quantity. In the old days, we would get together with the active shareholders, top 5, top 10 shareholders, and we'd say, what do you think, guys? And they would go, yes or no. Now, have this ambiguity of the passive shareholder market. So I think the stress on M&A and the accretion on M&A is going to be complicated in the near term until we really sort out how this passive and active management within the capital market space works. So yes, it's a necessary, yes, it should happen, but the lack of active management within the companies is making it hard.
If I could just make a comment on that, Sean, I think now we're really dealing with the market rather than specific shareholders that dominate the market. And so the transactions that we come up with, that we propose, we're going to be judged by the market, which can be much more harsh than people that you've known for 20 years or the major funds that dominate the market. So that makes it more difficult to do the deal and be confident that you've got the right deal. So there's more pressure on us to make sure we've got it right in terms of being accretive to shareholders, in terms of how the market will react. That's just the way it's evolving, and I don't think it's a bad thing, honestly. I don't think it's a bad thing. Yeah.
Let's stay with the M&A, Sean, and Sean too, sorry. Congratulations on the Victoria deal. You just closed it yesterday, and now we are talking about M&A, and you are just doing it again. And it looks like, anytime we have you on the mining panel, you have a new deal going on. Can you please walk us a bit through the Victoria transaction, as it is both a royalty and an equity deal? And this reminds us a little bit of your very successful Arizona mining transaction through your accelerator model a while ago.
Well, as you know, we're somewhat transactional friendly. We like to do a lot of deals. We did $1.6 billion worth of deals last year. We let off Q1 with the announcement of the Victoria deal, where we bought a 5% top line royalty for $98 million, and we bought 15.5. We upped our participation to 15.5% of the company for another 50 million Canadian. So our participation was 148 million in an overall project financing of 500 million. So our purpose as Osisko Gold Royalties is to be a provider of capital, essentially to single asset companies or development stories or expansion projects. That's where the royalty and streaming companies traditionally live. So the deal provides us with about 10,000 plus ounces a year of zero cost gold, maintains our margins and takes our gold equivalent ounces. We're looking for 80,000 ounces this year. This project in 24 months should add another 10,000 of that. So it's a pretty significant deal for us, and it becomes one of our cornerstone assets. It's in the Yukon. It's got a lot of exploration upside. and it's got a really skilled management team in place. So, you know, this is a really big deal for us as a royalty company as we grow. And, you know, our equity positions in a lot of these companies, we would call Victoria one of our accelerator companies now because we have both the royalty and the equity. And we expect that these development assets, as Shauna referred to earlier, are going to be quite a bit more important than they are today in the next 12, 24, 36 months as groups look to replace their ounces. So we've chosen to build ourselves as a growth company in the development space. And we've chosen that because our skill set is really exploration development, and we have the experience and the team for it. And we've also had the access to capital where we have about $500 million as we sit today to deploy in the markets. And if we had to, we could put $1 billion on the table for the right development asset. So that's our business. That's where we live. And we will always be in the development space. We're always going to be a little bit out of sync with the industry because we tend to be out in front.
Mm-hmm, absolutely. Mick, coming to your company, last year's stock price had quite a turbulent ride due to various factors such as political noise, but also index rebalancing. Obviously, all of this is over, and it will be interesting for us to hear some topics you see as relevant drivers for Oceana's performance going forward. Certainly, you had very good news on mine life extension on the Waihi, but also your other operations are performing well.
Yeah. Yeah, we've been through a peak period of capital investment with the development of Hale. We've been developing the underground at Didipio, and now we're profiting from that. We're starting to get into, back into serious cash flow from our operations. We're investing heavily in the future of New Zealand with the development or the future development of Waihi. We're spending about $40 million this year on exploration and underground development. Mm-hmm. Because we see a 10+ year life at Waihi going forward. It's a huge epithermal low sulfidation gold system there at Waihi. There's been 9 million ounces mined there over the last 150 years. And this operation's been going for 30 years and we're still finding more veins that haven't been discovered. So we've just applied for a permit to extend the mine life by another 10 years. So it's a 100,000 ounce producer, but importantly it makes $50 million a year of free cash flow. And it was a great acquisition for us that we got from our friends at Newmont in 2015. And we are New Zealand gold mining, so it was a natural fit for us. But there's a lot of value there to be uncovered over the next couple of years, and we'll bring that to the market through the exploration and development programs. Elsewhere in the business, we're expanding Hale. We want to take it up to about 4 million tonne a year or close to, and 200,000 ounces a year through the expansion of the open pit and the development of an underground mine there at Hale. South Carolina is a great jurisdiction, low taxes, low labour costs, very friendly environment to be operated, and we're very lucky and proud to be there. And that's really the foundation of our business growth in North America and indeed the Americas, which has been part of our business strategy for the last 6 or 7 years. Now we've got that foundation, we can look to expand our footprint in the Americas. And as I mentioned before, we've got these long-term pipeline investments in Argentina and Nevada. One thing I will say about us that I think differentiates us is we have been actively working on building the capability as a management group, as a company, with the ability to work in different jurisdictions across different time zones. Because I have this fundamental belief in my heart as a mining engineer over 35 years, is you've got to go where the gold is. You've got to have the ability to go where the gold is. And that is the basis for a sustainable business. We'll always be discovering and developing and operating new mines. We'll always be closing mines because ore bodies come to the end of their life. And so as a business, we need to create that fundamental ability to operate in different jurisdictions and in different time zones. Mm-hmm. And we need people who get that, right? So, we've got right now a platform to grow the business quite significantly. And, I'm looking forward to the next phase. It's what I call third base on the baseball diamond. So watch this space.
Yeah, fantastic. Sean, Agnico is dedicating a lot of money to your exciting Nunavut projects. Can you give us an update on the current status and what to expect in terms of relevance to the company's portfolio? And also, are you planning to further grow your northern business, or is there currently also parallel growth activity in your southern business?
As we see the production profile and the growth, we'll probably be 75% of our production in Canada. Based on the current year's guidance, we can see growth in production of about 50% from the guidance we've given in 2018, and that's over a 7 or 8 year period. But we're tracking to produce 2 million ounces in 2020. That's driven by Nunavut, as you said, with the development of the satellite deposit at Amaruq, which was a discovery by our team back in 2013. So 6 years from discovery to production, largely because we have an infrastructure in place to process. And then we have the Meliadine project starting in Q2 2019. So our production dips a little bit this year in 2018. We're in a transition year in Nunavut as we move away from the deposits that are right around the Meadowbank processing facility and develop the other 2 opportunities. We see Nunavut as a fabulous place to do business because it's got that unique combination that everybody in the industry is looking for. A place where you can actually do business and a place with tremendous mineral potential. So we see that. The people of Nunavut, as we said, own 18% of the landmass, and they were smart enough back in 1999 when they did the land claim settlement with the federal government to hire some smart geological consultant and to basically cover all the greenstone belts. So our overall exploration budget in 2018 is $157 million. Almost 50 million of that would be in Nunavut. We just need a few more drills up there. Again, that's where we see a lot of growth, and that's where we see a unique combination of the skill set. We've been up there for 10 years. I think there's high barriers to entry there because of the costs. We've been able to manage the costs because we have that platform in Quebec. And from that platform, there's a lot of skills that we draw on. And we do all of our logistical planning and support from Val-d'Or at the airport. We have a regional office. And you can't underestimate the value of having in-house skills to manage logistics because you got a 2-month shipping window. And you have to ship, in the case of Meadowbank, 70 million liters of diesel up there. So the future, I think, is important. We've asked our guys, what does it look like in 10 or 15 years? It's probably satellite ore bodies fed into centralized processing facilities with some mode of transportation. Maybe it's driverless trucks, we're not sure, so we're studying. But the key to Nunavut is to unlock the energy question, because right now we're one choice, diesel. But we're looking at wind power, we're looking at liquid natural gas, we're looking at small turbines in rivers, we're looking at small nuclear generation. We'll solve that. We're working with the federal government on ideas, and the government's been very supportive, understanding the importance of the Arctic to Canadian sovereignty and the vast amount of wealth that exists there. So we're going to be there for multi-decades.
Sean, also your share price doesn't seem to reflect, honestly, your value accretive deals. Can you share some thoughts on where you see that value has been created despite the current market perceptions?
Yeah, obviously, no CEO is happy with their share price on a downtick, and I would not be the exception to that rule. I think what we did is in 2017, we did a lot of transformational deals over $1.6 billion, based off of a market cap that was $1.4 billion. So we transformed the company, and I think that the market is digesting the evolution of all those assets that we acquired. And we have a high level of growth within the company, and that we're exposed to 4 mine ramp-ups in the next 12 to 18 months. And that we, most recently we've signed up for another 2. So we are a growth platform, and I think that, as those projects go through their ramp-ups and evolve, the noise will come out of our share price. It is, a big value, on a fundamental empirical value basis. We're trading at the lowest multiple within the royalty and space, but it's any time that you have a bit of vision and you're aggressive in terms of growth, the market will sort of retract on you. And we've been extremely aggressive in terms of building the company from $450 million market cap in 2014 to $2 billion now. Now we need to see shareholder depreciation come in. We do pay a dividend of 1.6% right now. And we have exercised a normal course issuer bid to repurchase our shares. And as long as the market is reacting that way, we will be a bidder of our own stock. And we have taken a very strong stance about what the value of our stock should be. And we have quite a well-endowed balance sheet with over $500 million of liquidity available to us on a $2 billion company. So we'll see how the market reacts, but we're going to be there to buy the stock back if we have to. We're quite happy to be shareholders of our own company. So, we'll do what we have to do, but we're going to be the winners of any time that there's a sale on our share price.
Fantastic. Mick, can you elaborate a bit on your free cash flow yield and EBITDA margins versus your peer group?
Yeah, so our free cash flow yield is probably double our peer group globally. We're about 8 or 9% free cash flow yield, and our EBITDA margin is up there with the best in the business at around 55% last year and similar this year, and it has been for many years now. And the reason for that is the quality of the assets and the way we run the company. You can't beat grade in the ground. You can't beat high quality assets that will always deliver a superior return. So that's the ethos. I mean, we made $175 million profit last year. We had an EBITDA of $400 million, and we're a company worth that's US dollars, I should say, and we're a company worth $1.6 billion US dollars today. So our price to cash flow is quite low. It's around 5, but we continue to enjoy strong profits. I think over the last 5 years or so, we've made about $500 million US dollars in profit in aggregate in our business. So we're doing something right, and we plan on keep on doing it. Yeah.
Absolutely. Sean, Agnico is often perceived as a bit higher valued than their peer companies. Let's hear a little bit about what the market is missing in terms of future upside, especially in relation to the company's growth profile and the sound jurisdictions that you are operating in.
I think that's over the last 30 so years, that's the #1 question we get is you're expensive. But as we like to say, we were expensive at $5, we were expensive at 10, we were expensive at 50, we were expensive when we were at 80. 20 years ago, it was a $5 Canadian stock price, so it's up 11 times. For the second year in a row, the Harvard Business Review ranks the S&P Global 1200, and they post a list of the top 100. 80% of that's based on shareholder return and 20% on sustainability. Only 2 gold companies made the list, Randgold and Agnico. So we've delivered value, even if you buy it when you think it's expensive. But I think what we like is the platform to add ounces. Not just in Nunavut, but even the asset Canadian Malartic. We were up there last week. There's tremendous potential below the pit, and that's one of the reasons that we wanted to take a look when it was put in play. And after doing the due diligence, our guys came back and said, you know what, there's lots of potential underground here. It's the old East Malartic mine. There's other deposits. You've got the ability to do low-cost underground mining at Goldex. So this is something we should look at. So I think with that exploration budget, you will see our reserves continue to grow, and you'll see our resources expand as we continue to drill a lot of our projects. But it's also the growth that we're seeing in production. And really, next year, second half, you start to see significant net free cash flow after this major investment we've made over the last 2 years. In 2017 and 18, we're spending $1 billion US on capital, largely to build the Nunavut platform. What happens in 2020 is our cash flow starts to increase dramatically as production rises above 2 million ounces. And next year, our capital comes off the peak of $1.1 billion down to about $650 million. So there's a lot of cash sitting in the business as we go forward. We've paid a dividend for 35 consecutive years. It's currently $100 million. We could easily increase that substantially. based on the cash that's coming into the business.
Yeah, that would be also my last questions to all three of you. Dividends, you said it. How important is for you and, yeah, let's say your stakeholders, first of all, dividends itself, but secondly, also maybe buy back shares and really reward shareholders? And how do you calculate it? Is it a function of the gold price? Is it a function of EBITDA? How do you do that? Maybe, Sean, you want to answer that first?
We don't have a defined policy except to pay one. And if you have paid one for 35 years in this gold business, it's clearly a priority. In terms of yield right now, it's about 1%, so we would see that growing as we allocate more of this net free cash flow. It's important. It's important because, as you said at the start, all good businesses pay a dividend. And that was always a signal that we wanted to deliver. The conventional wisdom in the gold space a few years back was they would say to us, why are you paying a dividend? Gold investors don't want a dividend, don't need a dividend, you don't need to pay a dividend. But we would always say we can go out and talk to a generalist investor and point to the track record and point to the discipline that's required to be able to do that year in and year out, given the volatility of the gold price, because we never ever sold an ounce forward. So it's just a sign of a good business, and we'll continue to pay one.
Mm-hmm. Yeah, there's a friend of mine always says, you know, we are reminding our shareholders that we are still alive.
Yes.
Sean, what's your thought on that?
So, you know, we founded the company in 2014. We paid a dividend in our second quarter of existence. So, you know, we take the dividend business extremely serious, and we are, you know, committed to doing only businesses that's going to allow us to sustain a dividend, and we want to be disciplined about it. We've adopted a dividend policy that's pretty simple. We don't overcommit to dividend, but we'll never ever find ourselves in a situation where we have to reduce dividend. So we'll only adopt a policy in which we're sure that we can increase the dividend based on cash flow models. And you know, on the share buyback policy, we've been, you know, 3 or 4 times through our normal course issuer bid, we have executed the share buyback. We remain disciplined on that. We do have a very specific viewpoint on what our stock is worth any given day of the week, and we will act accordingly and aggressively if we see that the market is offside in terms of how the valuation works. And you know, we have enough cash flow and a strong enough balance sheet that we're able to do that in a very sustainable way, because you know, we have 21 employees. We make about $300,000 to $500,000 a day in terms of revenues. So we're in a particularly different situation as a royalty and streaming company, where we don't have a lot of, you know, cost management to deal with, and we're working with a 92% margin from last year and an 87% gross margin as we go forward. So this is a fundamental belief, and that's where we stake our flag.
Mm-hmm. Mick?
Yeah, so we started paying a dividend 4 years ago. And we pay about, we have a policy of a fixed dividend plus a discretionary component. So we've been paying about $25 million a year in dividends. Don't pay any royalties. Not to we can talk about that. Yeah, not to other companies anyway. But the philosophy we have is that it demonstrates fiscal discipline, and that you're managing your business properly, and you're considering, you know, shareholders should get a return on their investment. And our ambition, our vision is to work to grow that dividend over time, and that's through the way we run the business and the quality of the assets that we invest in. So we're a miner. We explore, we develop, we produce gold, and we close mines, and we want to do that consistently better and better. And in that process, we will grow our dividend over time.
Fantastic. Great. Yeah, so far, so good. Thank you very much. Now we are open for questions. Patrick? Somebody has a question on that? Yeah, Pascal, I expected that. Can you see him?
Yeah, my question is about technological innovation. So Mick touched on it briefly. Production will be smarter and cheaper. But what are specific examples in your operations of mechanization and or automation?
Yeah. If I could answer that, there's a lot of great things happening in automation, particularly in the underground scene. We know about automated trucks, driverless trucks. Iron ore business in Australia is right into that. You know, I think FMG, which is the third largest iron ore miner in Australia, they mine 100 million tonnes a year of ore, and all of their fleet, all of their 100 trucks are automated. There's no truck drivers left in their business. That's how fast it's changing. And they're partnering with companies like Caterpillar, etc. In the underground space, it's also moving very quickly. You can now drill, load and fire a mining face without having anyone at the controls. And you can also remote bog that face without having an operator. That technology exists today. So within not too far away, you can imagine the mining being done by machines and the operators sitting at the surface. And that technology is within our reach. Now, the really big thing about that is that in any underground mine, you lose 30% of your time just getting people to work, getting them out of the face when you're doing blasting, when they go on their crib break. So there's at least 30%, it's about a third actually. Your effective working time in any underground mine is only about 65%. So just by taking people out of the workforce, we can improve the productivity of our underground mines by 35%. That will lead to huge improvements in productivity. It'll lead to huge improvements in safety, which is demanded by our communities and our society these days. And it will lead to lower costs of production and increased reserves. We always talk about exploration. We're running out of reserves. We've got to find more deposits. We've got to build more mines because demand's growing. A lot of mines have got a lot of gold still there, but it's uneconomic because our cost of production is too high. We reduce our cost of production by 30%, mine life goes up. And technology is within our grasp, and I firmly believe that.
Key driver, yeah. One more? Yes? You need the microphone, please.
He's just saying Sean to...
Just the same question to Sean.
Okay.
Just an example would be LaRonde, deep mine. As Mick said, a lot of time going in and out of the mine. So shift change, we're operating our scoops, manless scoops, from the shaft area with cameras and with joysticks. Basically, guys are sitting in big chairs with 2 sticks. They're operating the loader, and there's a guy right beside them operating the crusher. But for us, the focus is on, a lot of people are working on automation. That's going to work for everybody. For us, as we said, it's to crack that energy equation in the far north in Canada. We do that, and we just unlock tremendous potential up there. So that's where a lot of our innovation group is focusing their efforts.
Gary? Can you come over? Da, the Gary, geradeaus.
I have a follow-up question on that. You all have operations in areas, in quite remote areas, where people have no alternative than the mining industry. Don't you think that the mining industry will face more headwind in the future when you only employ a fraction of the people that you employ now?
The concept of automation works best in developed countries where your labour cost is relatively high. The payoff is less in countries like the Philippines where we work, okay? But there is an underlying, a more important factor in this, and that's safety. And our communities, societies expect today that people don't get hurt when they go to work. 30 years ago, it was normal to expect someone to die in an underground mine. Oh, that's what we do. Just, we're very sorry about it, but we'll keep going. Today, you have a death in a mine, open pit or underground, you shut down for a week, right? Not because, something's wrong, but because that's what's expected. And I think the safety aspects of underground mining, we talk about social license, There's nothing more important to our communities than their people going home every day, right? If we can prove to people that underground mining is safe, then it doesn't matter whether you're in the Philippines or whether you're in Canada or the US or Australia, people will say, yes, that's a good thing if we don't have our people exposed. So that's so much more important.
Yes, gentleman up there.
Just getting back to the concept of peak. Peak oil came about because we consume all our oil and we have to keep finding more. That was used to justify the oil price being above $100 a barrel. At some point, people transferred that to peak gold. Jochen, you've already told us that just about every ounce of gold that's ever been produced is above ground. So you've got a potentially limitless supply of gold depending on price. But the real question is, which is holding back the gold price, is how can you have a peak of anything when in a morning you can have 12 months of gold supply shorted into the market to totally destroy any enthusiasm to blow away any bulls? How does that equate with the concept of peak gold?
Sean, maybe you?
I'll take the first shot at it, but I think that the other gentleman beside me can take it. At the end of the day, we've been at peak gold for about 5,000 to 6,000 years. There's been gold produced every year. It increases above ground capacity is about 1.6% per year. It's been the same for an awful long time. That's the algorithm that Bitcoin used to create their cryptocurrency, was how much more gold there was created every year. At the end of the day, gold is a hard asset. It's an offset to belief in fiat currencies. And Martin's going to do a really better job than I am or the guys on the panel, I think, in terms of telling you that. But I don't really see, peak gold being an issue in terms of demand for gold. Everybody talks about it's going to be different this time. It hasn't been different for 5,000 or 6,000 years, and I suspect that it won't be different for the next 5,000 or 6,000 years.
I can't answer the question because I don't understand it. Sorry.
I think we'll leave that to Martin.
Okay. Another question? Great. Then we are fine. Thank you very much. Sorry, there's one more. Björn?
Thank you. This goes to Sean. As you mentioned quickly, Nunavut is one of the most sought after place for you guys to be, I think, aside from your healthy rival taking a smaller stake in some other companies. You guys rule the district. So the question is, you mentioned that here and also on some other occasions, that this is the future of the company, more or less. How do you see it? How much investment would you put to develop your own mines or exploration project? Or also do you see some M&A potential up there?
Well, as far as M&A goes, we have over 500,000 hectares of ground. It's expanded 10 times in 10 years, and we own it 100%. So we're going to drill it and explore it. We're not in any rush, which means we don't have to buy other land packages up there. We've got more than enough to keep us busy for a number of years. But it's good to have others up there exploring and drilling, and not just for gold, for other metals, because ultimately there's going to be many, many mines up there. And so we're at the forefront of that. We have a competitive advantage. There's some catching up to do. We certainly know there's a lot of interest. And we've been approached in the last year from Asian interests, from Middle East interests, wanting to buy a direct interest in our Nunavut business, which we refuse to sell them because of the upside potential there. So that's going to be an important part of the mining industry, but it's also going to be extremely important for Canada as a company or a country that relies on resource development. There's a vastness of wealth there that will be developed, and it'll be developed certainly from a Nunavut perspective with our Inuit partners, to the benefit of not just them, but for all Canadians.
All right, that's the end of the mining panel. Thank you very much.
Thank you.